Today, you are going to learn how to do a live market analysis of where the big boys think Nifty or any other large stock will go. And for this, we're going to use something called PCR in options, which will tell us exactly what their positions are. And from that, we'll derive where they think the markets are going to go. But before we actually go into this 3-step process, hit like, hit subscribe so we can see that number go up and feel good about ourselves, and say something nice in the comment like LearnApp rocks. Let's begin step number 1. So before we start with PCR, let me just make sure you understand what selling and buying a call or put means. So when I buy a call, I am bullish on the market. And when I sell a call, I'm bearish on the market or think the market is going to go flat. Similarly, if I buy a put, I think the markets are going to go down. But if I sell a put, I think markets are going to stay flat or go up. Now, with just this piece of information, we can actually decode an interesting story. And this story is about Mr. FII and DII. This guy over here has a long-term portfolio of big boys. Imagine the owner of Nike, Adidas, all these guys investing their money somewhere. They entrust it with a bank or a PMS or a hedge fund, etc., etc. And a lot of them use this money and put it into bonds. Again, some part of this is put into stocks. Now, you tell me, if you're a billionaire living in the Bahamas, would you want your stock to be mostly in option trades or mostly in stocks invested in the long term? The answer is simple. You would like longer term horizons because you have liquid cash. But there's a problem here. As you have invested over the long term, what do these hedge fund managers do? The hedge fund managers have to generate money more than Nifty. More than Nifty, to be honest, is really tough. So what they do is they use options to earn a little bit of more money on top of what they've invested in. And their positions in futures and options can tell us where they think the market will actually go. And remember, we're not tracking one FII, we're tracking all the big boys together on Nifty. Knowing where their option positions are will tell us whether they're bullish, they think the market will go flat, or they think the markets will go down. Isn't this interesting? So that brings us to PCR, which is put-call ratio. Simply, it's all the puts in the market divided by all the calls in the market, and this gives us a ratio. Let's see an example, but remember, whenever we're looking at the put-call ratio, we're seeing it from the seller's perspective. Why the seller? Because retailers like you and me want to buy options because we don't have money. But they do, and they understand that you can make money in selling calls and puts more because you can make money as the market goes sideways, goes down, etc. And they are on the selling side. It's always assumed that. So let's understand what PCR is with an example. Let's say put OI is 750 and call OI is 500. If you divide this, you'll get 1.5. This basically means there are more puts than calls. Now, more puts, you might think that is bearish, but no, you have to think the opposite. So opposite of bearish is bullish. It means that all the FIIs are actually bullish in the market because they've written a lot of puts. That's why those contracts exist. So when you see 1.5, you can conclude that the big boys think the market is generally going to be bullish. Let's see another example. Let's say put OI is 500 and call OI is 1000. In this case, call is 1000 and sounds like it's bullish, but no, we have to see it from the seller's perspective. So the opposite of that is bearish. So we know that the FIIs think that the market is mostly going to remain bearish or flat. This gives us some interesting ideas because now we know in the short term, what do FIIs think? Now the question is, at what point do you think the FIIs think the market will go up or down or remain sideways? There is actually a way to analyze an option chain. If you want us to cover that, please put it in the comments and we'll make a separate video altogether. Let's see one more example. The third example, we can see that the call and put is actually the same. So the markets think, or the FIIs think, the markets are going nowhere. They think it's going to remain sideways when you see a PCR of 1. And here's a simple guide. Pause the video, take a screenshot on what to do when you see a PCR number. Is it bullish, bearish, or just plain boring neutral? So let me show you how to actually calculate PCR by going to the NSE website. So I simply went to the NSE website and opened up an option chain. I obviously have Nifty open. I'll just scroll down to the end to get my total call OI. So I'll copy this, put it on an Excel sheet that I have, And then I'll copy the total number of puts over here. As you can see, we have a PCR of 1.2, which means it's bullish. And the expiry for this contract is 31st August. And today is 8th August. I'll do the same thing on Bank Nifty. And all I need to do is copy the OI for Bank Nifty, paste it in the calls region, then go back, copy the puts data, paste it over here. And we get a PCR of 0.9, knowing that it's slightly on the bearish side. So in summary, the put call ratio can tell us where the big boys are thinking the market will go, whether it's going to be sideways, going to move up, or going to go down. But it doesn't tell us where the market will go. It tells us where they think the direction will be. So you have to use this in conjunction with an actual strategy or an indicator, something that's backtested. This simply confirms where you think the markets will lead towards. So imagine there are elections going on. This data will tell you where you think the markets think will actually move. And you can use this in conjunction with some other strategy that you have. Now, there is one problem with the entire PCR data because we look at the entire chain for calls, all the open interest, and all the open interest for puts, we get a certain number. Now, sometimes people write calls and puts really far from the strike prices. These are really far from where the current market price is and is done for hedging purposes. So slightly distorts the PCR. If you want to be a little more accurate, remove these really far out of the money call and puts and then calculate the PCR to get a slightly better piece of data. If you found this useful, please let me know in the comments below. And don't forget to subscribe so you can see all the effort we put to actually do this, and say something nice to the editors, the writers, the researchers. That is Team YouTube LearnApp, and see you in the next video. Bye-bye. So as you can see, we can see, aha. गुड देखो स्माइल कर रहे हैं आविद हसन